NextEra Energy stock is down around 40% year to date, dropping rapidly recently, causing investors to wonder, is this a potential opportunity? In this video, I'm going to cover, what do they do, their historical financials, and how should you think about it as a potential investment. If this is your first time watching, my name is Daniel. You're watching Unrivaled Investing. I appreciate hitting that thumbs up, hit that subscribe button. So let's dive right into understanding what's going on. So historically, looking at NextEra, they've delivered actually very reasonable financials. 8% annualized earnings growth, nearly 10% annual dividend growth, nearly $2 a share now in dividends, saying we have a long history of outperformance relative to, let's say, the tech sector or consumer discretionary or the S&P 500 utilities, saying nearly 700% total return. Now, this is from a few months ago, over a 15-year period. So still several 100% return over a long time frame. This is intriguing. I want to learn more. And by the way, management has a strong outlook. They're saying we think we could do $3 in earnings this year, a little more than $3 next year, and up to $4 by 2026. And we would be disappointed if we're not able to deliver results at or near the top end of these figures. So not only do we think we can continue growing, but we would be disappointed if we don't execute on this, if we don't do even better. And they also think they can continue to growing their dividend around 10% a year. So I'd argue this is roughly a strong outlook. Management saying, hey, based on this, it's trading at around 17 times forward earnings to 2023, around 13 times if you go out a couple of years. So this is arguably very intriguing. I want to learn more. So what is NextEra Energy? You have to peel apart the different layers. You have a lot of different entities here. You have FPL, NEE. What is all this different stuff? And so when we look at FPL, so that's Florida Power and Light, this is the largest electric utility in the U.S., has something like over 12 million customers, 5.8 million customer accounts, 34 gigawatt hours of operations, in operation, generating $17 billion in operating revenue. You can see it's spread across nat gas, nuclear, solar. You see it's across the state of Florida. But the key point that you should be taking away from this is, okay, this is a utility. And utilities are a different type of beast relative to a lot of other stocks. So they need to be considered differently. And I'll talk more about that in just a second. So it's a utility. Around 50% plus comes from their residential customers, over 30% commercial customers. And they're expecting to invest tens of billions of dollars. And they have invested tens of billions of dollars. And keep in mind, this is just one of NEE segments, NextEra's energy segments, which is FPL, their Florida Power and Light. They're saying we're currently mostly nat gas, but in the next few decades, our goal is to become mostly solar, investing a lot in a decarbonization opportunity. And so the key things that you need to start thinking about, given that we're talking about a utility here, is one is cycle. Where are we in the cycle? What does it mean for the business? Because for a utility, you're talking about a company that invests a lot in fixed assets. It's generally a lower return on capital business. It's a monopoly type of business. So that's the attractive part. But because it's a monopoly, it's heavily regulated. The regulators say, hey, this is the limit on what you can return on your equity. So it's important to understand that. So if you have a capped rate on your equity of, let's say, 12%, and, let's say cash becomes more compelling, then your relative value proposition is sort of declining from an investor perspective because your capped, let's say, ROE is 12%. So let's say 12% ROE and cash goes from zero. And by the way, that's the rearview mirror. 15 years of outperformance. Well, that's based on, a ZIRP economy, zero interest rate policy. What are you doing in a real interest rate economy? So that's the first thing you need to think about is, where are we in the cycle? And I'd argue we're at this point in the cycle where interest rates have gone up. They might go up. They might go lower. People aren't really sure what the next step is. Some people are saying the Federal Reserve has stopped from here, but higher interest rates hurt the relative value proposition from an investor perspective of owning utility. A utility is something that a lot of investors pile into when there's like, oh my goodness, there's a recession and the Federal Reserve is cutting interest rates. When you have that dynamic, then you go, oh, okay, easy money and very stable business, and even in a recession should do okay, should do well because it's a monopoly. People need to keep the light on. So you see investors bid this type of business up, a utility up, during that part of the market cycle when you have rate cuts, not really when you see the rate hikes. So not surprising to see a 40% drop year to date. Another key aspect whenever you're looking at a utility is in order to generate these returns, you oftentimes have to borrow a lot of money. Now, part of it is because the return on capital is low. And so you say, hey, if I borrow a lot of money through financial engineering, instead of getting maybe a 3% or 4% yield, maybe what I could do is I can make all these investments, but by using leverage and borrowing money, I can now get a 12% or a teens% return on equity. This is a tricky dance because once again, you're borrowing money, and as interest rates move higher, it does hurt the business. It makes it harder to run this business. How much money do they have? How much debt do they have? They have around $70 billion in debt. This is based on looking at AI ticker chat and the AI audit function where, you can click on any of these line items to learn more. And, seeing $70 billion in debt, like, hoo-ah, that's a lot of debt. So do they have the income to sort of cover that debt? And just based on looking at last year, generating around, let's say, 8.5 billion in EBITDA. Like, you could round up, I'm sure there's some adjustments. Let's make it 10 billion. So, 70 billion in debt versus, under 10 billion in EBITDA. So you're talking about 7 to 8 times, leverage. That is a lot, when I'm looking at this. Now you might say, well, that's, it's not a lot necessarily for utilities, but overall, I don't like these types of setups. So to be very clear, for my own personal investment journey, I want to avoid blowups. And the way you blow up in finance, there's a few different ways, one of which is by borrowing too much. And when I see a company that's 7 to 8 times levered, yes, you're a monopoly. So that's important to recognize. And you have this very strong position in Florida. So that's very important to understand. But debt is how a lot of stocks blow up over time. It's either debt or you have, a value proposition that no longer resonates and a competitor, eats your lunch. Those are generally the key ways that investors lose. The third key way is investors overpay. And I think you're sort of seeing 2 of those key risks playing out with NextEra right now, which is the valuation is coming down in addition to the concerns around debt. So how are they financing this business? Well, they generate a lot of cash flow from operations, around $7-8 billion a year. Surprisingly, hasn't grown a lot over the last couple of years, but they're investing so much. Florida Power, and Light, that is sucking up all their cash flows, plus their independent power and other investments in their other segments is another several $billion. So they're financing a good chunk of this with debt, which does make me a bit cautious. And so, and this caution is taken to, 10, 1 out of 10, it gets to level 10 for me personally. When I see that, you have these huge cash outflows, but by the way, you're still paying billions of dollars in dividends, and they're on track for, I think, $2 billion and, a couple $2 billion, $2 billion, I think, in the first half of this year. So a couple $1 billion in dividends. And so I'm looking at this and I'm thinking, this makes me nervous. When I see $10 billion cash outflow, free cash flow before dividends, $6 billion, -6 billion, -8, -5, these are huge cash outflows financed by debt. This instantly, something about management. Management is being very aggressive because you could argue there's no reason to be paying a dividend unless you have the free cash flow to support it. That would be a conservative approach. But an aggressive approach is, hey, why don't we lever up and with the proceeds pay our shareholders? That makes me nervous. So my interest is rapidly dropping. Let's learn more about this business. So we briefly talked about FPL, which is a rate regulated utility. What about the CH? So this is, Capital Holdings, which includes their competitive clean energy and transmission business. What's going on here? And I'm not going to cover the full extent of it because they have a publicly traded yield company. So this is the one that's focusing primarily on their dividend, which is NEP. But there's a lot here. There's a lot of different components here. And so looking at it, you're talking about NextEra Energy Resources, one of the leaders in clean energy in North America, talking about 31 gigawatts of clean energy in operation with wind, solar, nuclear, once again, this is around the United States, with investments expected to be very significant in the years ahead. When you look at the total assets, it's around $75 billion, which is slightly less than what you're looking at with the Florida assets. Why is the stock going down? I think a key aspect comes from the fact that one of their subsidiaries, which NextEra Energy owns over 50% of the subsidiary, which is publicly traded as Next Energy Partners. So this is a limited partnership vehicle designed to pay out to shareholders. They're cutting their expected growth rate from around 12%, teens growth, to maybe 5 to 8%, or around a target growth of 6%. So that is making investors a little nervous. The part of the reason why they're doing this is because they're saying, look, higher interest rates are impacting our business. And that's what I talked about earlier, when you need to understand what type of business you're dealing with and where you are with the cycle. And this is another part that really bothers me, is that they're saying, hey, we don't expect to require growth equity to meet our revised growth expectations until 2027. But maybe if favorable market conditions exist, by the way, they don't, the stock has been plummeting, as well as this limited partnership, maybe we would issue some stock in the market. So this is another data point that, I've already gone to, okay, you need to really do something to impress me right now. At this point, it's a pass for me, because I'm looking at this and management saying, by the way, in order for us to, grow in the future, and maybe not, it's unclear, our growth equity is going to be by 2027. We're going to need that. And I would much rather be in a business that controls their own destiny, that doesn't have to rely on the capital markets in 2025, 2026. So they're saying, hey, our balance sheet and our cash flows are going to be fine until 2027. By 2027, if we want to start growing at a faster rate, we're going to need to issue stock. So I look at this, and maybe the sell-off is overdone in response to, this news that you're going to be growing at 12% versus 6%. And, hey, we'll need to issue stock at some point in the future. But a lot of this just rubs me the wrong way. I do not like businesses that perpetually need to tap the capital markets. You are requiring the kindness of strangers. You look at the best businesses in the world that have delivered, world-beating returns, like Berkshire Hathaway. It hasn't come from repeatedly tapping the capital markets, relying on relying on strangers. It's come from opportunistically growing a business, saying, hey, we have a float that's growing, we have insurance premiums coming in, and we can reinvest that in a clever way. Here, this is much trickier, where, and this is a key point that a lot of folks have missed. Berkshire's float, these insurance premiums that they get a hold on to for Berkshire Hathaway, that value of that float goes up in a higher interest rate environment, because now you can reinvest that float into cash that's yielding more. Whereas something like this, a utility like this is getting hurt in a higher yield environment. So where does NextEra Energy go from here potentially? So first of all, in full disclosure, this is not financial advice. Also, quick plug, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for premium annual subscribers. By the way, I'm going to be raising the rates shortly, so now is the time to lock in the favorable pricing. So how to think about this? I just touched upon Berkshire Hathaway. How do you think about valuing this? And I think it always comes down to thinking about things like cash versus earnings. And, in this case, you're weighing the value of cash versus the value of earnings. And keep in mind, it's earnings in the forward period. And in this case, I think investors are increasingly saying, wait a second, holding cash might just be a better deal. For example, you can get between 4 and 5%, 4.8% plus holding your cash at Interactive Brokers. That's personally what I'm doing. See the link below. And, and by the way, that rate might be going up further, with fears that, hey, we might be in for a period of stagflation. Have you seen oil prices jump 30% in the last few months? Jamie Dimon, head of JP Morgan, he's saying, you know what? Investors might be prepared, should start preparing for maybe even a 7% rate. Whoa. So going from 4 to 5%, 5, 6, 7, maybe he's being overly, let's be very clear. JP Morgan does not benefit from saying, hey, the economy might get a kick in the nuts with a 7% rate. Like, let's be honest here. JP Morgan, this does not benefit, Jamie Dimon. if anything, having a rosy outlook for, hey, we can underwrite these loans is how they would grow. But him saying this is saying this is a legit risk that investors should be mindful of. So I hope this doesn't come to pass, because I think there would be a tremendous pain in the equity markets if that were to happen. So once again, thinking about this sort of trade-off between what you can get in terms of yields. So, you're getting 4 or 5% with cash. And here the equity, after a lot of debt and potentially requiring a lot of debt issuance in the forward periods, you're maybe getting a 6 to 8% yield. Is that really enough? I personally don't think so. Like I recently did a video on Crocs. I don't own Crocs at this point. I'm going to research it and learn more, and I'm going to do a letter on it for my subscribers at Unrivaled Investing. But in that video on Crocs, I called out it's a stock trading at 7 times earnings. There's a lot of actual stability to this business, as a lot of people use these things for, like you have surgeons wearing them, you have nurses wearing them, you have, it's not just a fad. It appears that there's a level of business where people just like the convenience of the shoe, and for it to be trading at that multiple. And by the way, there's a lot of free cash flow. That is a lot more intriguing to me. Those are the types of companies that I do a little bit of a deeper dive on, that I share with my subscribers. With NextEra Energy, you're saying, okay, 6 to 8% yield versus 4 to 5% cash, and maybe 6 to 8% yield plus some growth over time. It makes me very cautious. And the other aspect is I would much rather own, businesses with a strong net cash balance sheet. I look at this, and that level of leverage it's not likely to blow up because it is a utility, but it does make me think that they might be a forced seller, where they say, and they recently did sell some assets in Florida. So could this be because of higher rates that they start going to the folks like Berkshire, the ones with a net cash balance, and say, hey, we got this transmission asset, we got this nuclear asset, we got this nat gas asset. No one else is willing to buy it. Could you buy it? And Buffett being like, well, I'd be happy to help you. By the way, it's going to cost you, a 12% yield effectively. And so I think you're going to see potential dynamics like that for this type of business. I suspect you might see additional asset sales, if the debt is a problem in the future. So that's another aspect. I also, once again, I want to find businesses not only that have strong balance sheets, but also can benefit from higher rates. And I call out those types of businesses once again to my subscribers. I also, lastly, don't like businesses that rely on the capital markets, that require, saying, hey, we're going to have to issue equity in 2027, and there's billions of dollars in debt that we're going to have to issue. And by the way, the dividend is completely not covered. So in order to get me interested, I would need to see them go, oh, by the way, we're now switching from an overly aggressive expansion policy to a more balanced approach, where the dividend is actually paid for from free cash flow, real free cash flows, and the growth is going to be paid for from real free cash flow. And maybe, we could even pay down a little bit of our debt if we want to. So that would make me a lot more comfortable, where they say, hey, here's our free cash flow. Here's what we're going to do to, invest it in this business. But by no means do we have to rely on the capital markets to get great expansion. And so that's my hesitancy as I look at NextEra. I think some investors, that 6 to 8% yield, when you're saying, it's trading at somewhere between 13 and 17 times, that 6 to 8% yield when you're thinking about it. And keep in mind, that's an earnings yield. You're not getting all that as a dividend. You're only getting, 3.5%, 4% right now. So I look at this, and I just, it just depends on, first of all, it depends on investors. Once again, requiring on the kindness of strangers is 8% enough? Personally, I wouldn't think so. Personally, it's not enough for me. For some investors, they might say, yeah, this is, an 8% forward yield might be enough for a utility monopoly type of business. Okay. It just depends on the investor mentality. I would rather have a company that has an 8% yield and is self-financing a lot of growth. And I think you can find those things. So anywho, that's my perspective on NextEra. If you have a different opinion, would love to hear it in the comments below. I just think that there are better bets out there. Thanks so much for watching Unrivaled Investing.